Good afternoon and good evening, everybody. It is Tuesday, December 23rd. We are in, I think, the middle of a Santa Claus rally. We've had two positive days this week. I guess Santa Claus has come to town. Maybe tomorrow he could really deliver a big rally on Wall Street. We saw the Dow go up just a tiny bit, the S&P go up 0.46%, then the Nasdaq go up 0.57. Nothing overly exciting to report. I think trading volumes are pretty low. There's a lot of people taking the week off, and that's understandable. It's a big holiday week. We'll be open tomorrow for half a day, so we'll see if the market's going to move in the morning. We look at the heat map. NVIDIA really picked up a nice rally today, up 3%. Incredible. And NVIDIA had sold off for about a month, so became a nice little opportunity to pick up some shares and watch it rise. Google went up nicely, 1.5%. Meta was up 0.52%. Microsoft was up. Amazon was up nicely. Energy stocks picked up a nice bid. I guess oil prices were higher. Consumer staples really sold off. Now, next year, we're going to have lower interest rates. The economy's good. Unemployment isn't a big problem. So I don't know that consumer staples are a great place to invest right now. But we'll see. Looks like software applications, the market's at it again, just selling those off, creating really good opportunities. Should these ever rally again, I think there's a lot of value to be had here. And financials did okay. Some green spots out there. So it's a mixed day, but mostly higher. NVIDIA going up makes a big difference. Amazon's a big cap. Google's a big cap. All the big caps were up. I can't see one of the major caps. I guess Tesla is the biggest company that was down. So it's a nice little rising day. Thanks for joining me. It looks like Brucey is on. You want to look at Hack. Glad to look at it. I put it on the list. I wanted to open with kind of a thread of research and stocks that I wanted to look at. We'll start there, and then we will cover Hack. And if anybody else wants to see a stock, do exactly what Brucey just did. If you're a member, just put it in the chat. If you're not a member, no big deal. Buy a super chat, $5 super chat, and then put your stock symbol down, and we will put it on the list to research, to do some due diligence, to see if it's a company that looks investable, good investment, bad investment. Does it have risk? Does it have problems? That kind of thing. Good to see you, Brucey. All right, so the market is kind of having a smooth week so far. No big deal. What I wanted to do on this live stream is take a look at a thread of companies that belong to renewable energy, and specifically solar. Here's why. So I was watching, I think it was a Bloomberg report, and talked about solar. And I expected the conclusion to be solar is not that successful this year. Not a lot of solar panels are being sold. Not a lot of equipment's being sold. It was actually the opposite. A lot of solar equipment's being sold. There was actually growth. And it may not be happening in the US, but it's happening in a lot of countries that see solar as a very quick way, very flexible way of adding power to their grid, to their home, to their business. So they're seeing a lot of growth. And that looked pretty interesting. So I wanted to just follow that kind of idea, look at kind of a cross section of stocks, and then see if there's anything there worth reporting here. Looks like Mark is on. Good to see you. You want to look at Celsius? We looked at Celsius, and we looked at it. I could have sworn yesterday or the day before, and we looked at it this morning on the investor call. So it looks like Celsius is getting people's attention. It should be, because it sold off a lot, bringing down the price of Celsius while the company continues to grow top line revenue. So it's become interesting. I have it discounted. I'll show that to you in a little bit, and we'll talk about it, see if it's a good investment. Genetic Smite, good to see you. So you're seeing a lot of solar panel installations in UK, and that's what the report was concluding, that solar is being installed in a lot of places, and it doesn't seem like it's going to stop, because it's not in a, like, the infrastructure you have to put solar is not that much. So and I got it, Mark, sorry about that. PTC is the stock, not PLC. Got it. So thanks for weighing in, Genetic Smite, that you're seeing it in the UK. I think a lot of countries are seeing it. So let's get into this thread now. And my company just had contracts for, look at that. Very interesting. I put solar on this house. People are putting solar. It's not that difficult. It actually just plugged into my infrastructure, I'll call it, in a way. It wasn't getting a electricity bill any longer. Who wouldn't like that? It was saving me like $150 a month. Who doesn't like that either? That's return on investment. All right. So I've been using Gemini, and I'm sure you could use other AI apps like ChatGPT, or pick your favorite. I like Gemini. So we're going to go with Gemini on this example. And I just said, hey, what are the most valuable renewable energy stocks? GE Vernova, and I'm not quite convinced, because I am familiar with GE Vernova. That is not renewable. I know that NextEra is renewable. So we looked at NextEra a couple of days ago, and I think it was Ricardo that asked about that. So we're going to look at NextEra again, just to compare it against other companies in this space. And the next one here, Iberdrola. So these guys do offshore wind. Interesting. So we'll take a look at that one. And we have looked at like an offshore company. Now, why am I looking at power generators like this, right? Is, boy, if you promise to build nuclear reactors like Oklo, boy, your stock's really working. And you have all these like bets on, hey, we can create power, but there are some real proven ways to create power. Wind, solar, hydro, of course, burning coal and burning other things. So let's kind of take the tour and see if maybe there's good opportunities around that we want to consider. Constellation Energy, let's take a look at that one. And that one is CEG. I'm making some notes here on the side, so bear with me. And I'm going to catch up on that chat. So I know that there's a chat message or two that I need to read. But let me catch up on, let me kind of go down this thread, and then I'm going to take a break and answer your message. SunGrow Power Supply, Chinese company. But are these guys publicly traded? I don't think they are. All right, First Solar. We know what these guys are about. So First Solar. I'm curious to see if First Solar is truly seeing like a pickup in revenue. That'd be interesting and surprising, frankly. That report surprised me. I thought I was going to hear that the solar industry is collapsing, with a lack of revenue. Nope, they're doing just fine. All right, so Vestas Wind Systems, okay. Bloom Energy, let's put that one on the list. BE. And we have looked at Bloom Energy in the past. So Bloom Energy. All right. And All right. And Enphase Energy. Of course, good old Enphase. Enphase is a big solar company. And I'll put that on the list. What's the other one here? Next Tracker. I think I want to look at Next Tracker. I think it is a technology that enables whoever installs industrial level or commercial level solar. It pivots the panels so that it tracks the sun, and then you capture more of those sun rays, and you get more power. So it's a good idea. All right, so I did my homework there. Let's ask a different way, which is, so I just want to make sure I catch all the companies that I want to include. So we got First Solar, Next Tracker, Sunrun. So Sunrun is ticker is Run, and it is Sunrun. Okay. We got Enphase. We got Next Tracker. We got that one. Shoals Technologies. Okay, let's take a look at that one. Shoals Technologies Group. All right. So we have NextEra already out there. And I've looked at these. These are not like solar. They have some, but most of their power is generated the traditional way. Okay, so all right, we're good. All right, so I got a good list of stocks to kind of operate with. Now let's take a look at the chat real quick. Looks like Genetic Smite. Let's see here. Yeah, I can look at NVO. NVO had big news with its oral version of its weight loss being FDA approved, and we can look at it. I think, spoiler alert, Novo Nordisk is discounted. They are nicely discounted, but it's been kind of a stock that is, really tested the patience of investors. And when we get into it, you'll see what I mean. So glad to look at NBO. Okay, so we are looking at renewable energy solar stock to see if we can find a diamond in the rough, something that maybe the market isn't paying attention to, that maybe should be on our radar. In order to outperform in 2026, we don't necessarily need to follow the pack, because the pack's going to be the pack. The market's going to be the market. And maybe we can find a couple of usual suspect stocks that are going to perform adequately, maybe up 10%, maybe up 20%. But if we find a diamond in the rough that is maybe being neglected, ignored, has really good fundamentals, has a really good forecast, we buy it at the right time, that could be a nice 80% rate of return. It could be a really nice stock. So that's what I'm going to be going after here. All right. So NextEra Energy, we looked at it. It's up 11.3%. Over the 5-year, not a good story. It is up 6.8%. NextEra Energy, through its subsidiaries, generates, transmits, distributes, and sells electric power to retail and wholesale customers in North America. The company generates electricity through wind, solar, nuclear, natural gas, and other clean energy. It also develops, constructs, and operates long-term contract assets. So these guys are trying to build along, low carbon energy. They pay a decent dividend at 2.84, but the rate of appreciation, this is not a success story here. It is not. We should not be satisfied with a dividend and then your stock barely went up. This is a failure. It's not a success. Over the 1 year, this is acceptable, but they got to keep this going. Double the value of your company every 5 years is the intent or the desire that I want out of a company. All right, so we've got NextEra Energy. They're a pretty good size cap, $166 billion. Okay, and historically, they've had kind of up and down years. So you have a year when revenues went up, came down, went up, came down. And if we look at the trailing 12 months, it's been pretty flat. All right. Now there's a lot of demand for power. So I have to think there's got to be bigger demand. I would think that the revenues are going up. Now they do not produce free cash flow. This is one of the things about utilities that I don't like is they have to invest so much into their businesses. What I concluded on this company is that they're not only investing to repair and maintain their current power production facilities, but they're actually building additional capacity, which is good. So that's good. That means they're going to have bigger revenues in the future. And they have decent profit margins. 24% is very good. Okay. And let's look at that forecast. Is this business going to grow? If we look into the future, a couple of years, and the answer is yes. I do like this growth forecast. And this year, they're growing nicely. Last year, they had a down year, but then they're going to consistently grow. So this looks pretty darn attractive, frankly. And their PE ratio is coming down into the teens. That looks good. So I'm liking what I'm seeing there. And it's in a space where I have no investment. I haven't invested in this area. I don't think I missed out on anything based on what we were seeing there. Now, I think I did some work on the valuation. I think a couple of days ago when it was asked about this stock, I created a valuation, and it looks like I gave them a free cash flow that netted out the capital they were spending to grow the business, because that's kind of an investment in the business. Okay. After doing that, if you value the company based on earnings per share, there's a discount available. But if I look at the cash flows, it's actually doesn't value very well. Overall, it's about a 14% premium you're paying for NextEra. So I would need this stock price to come down to like $60, $55 a share. And maybe I might invest at that point. So this one here is it's not looking too hot. It's looking like maybe a pass, a sell, with the price just being too high. And, I'm looking at a stock that the market didn't really buy up. It's just not a very desirable industry. Now, the big story of how data centers are consuming so much power, why isn't that helping NextEra? I can't answer that question. I just ask myself the question of, if so many energy companies are just catching such excitement and big investment, why isn't it helping NextEra? I don't know. All right. So I'm going to move on to the next stock. While I do that, I'll let Benton know that I am going to put GFS on the list. Good to see you, Benton. So GFS, it's on the list. All right. So the next stock that I wanted to look at on this list was IBDRY. That's Iberdrola. These guys are in Spain. So they're doing elec- elec- electricity generation using offshore, onshore wind, hydro, conventional nuclear. Okay. All right. And over the 1 year, look at that. 57% over the 5 year, 55%. Looks like most of their gains are happened over the last year. So very good appreciation. Looks excellent. Dividend looks pretty decent at 2.63. Pretty good size cap, $141 billion. They have had a pullback in their revenue. And this kind of looks a little bit like what we saw with NextEra. You had growth in revenues, contraction, growth, contraction. Most recently, flat, just like NextEra. That is interesting. Well, why is this stock rallying? Well, NextEra is kind of not really catching a whole lot of excitement. Now this is an international stock over the counter, so I don't get to see a forecast, unfortunately. But let me see if Gemini can help me out. Let's see if Gemini can find forecast information for this company. Look at that. It did. And it's going to cite its sources. Here's its strategic plan. So AI is helping me out, by the way. For the record, it's helping me out. Now, the growth this year looks to be pretty exciting. That's why the stock's really rising. Next year, not so exciting. And then the year after, not really exciting, 4% growth. So, the future is not all that beautiful or pretty or exciting. And when we look at cash flow, it's not available. They have a lot of debt, $67 billion of debt. Whew, that's a lot of debt. Debt to EBITDA 3.55. Yeah, I don't like a lot of debt, but these guys have to go borrow money so they can build these power generation assets and infrastructure. Now, what did I want to look at? I want to look at financials, and I wonder why we can't get the free cash flow number. Let's take a look. So for the annual, cash from operations almost 12 billion, capex. So these guys do cash flow. Yeah, so these guys do cash flow. They're doing quite well. So, So they're going to have cash flow of about $3 billion free cash flow. Yeah, this one's just not going to float my boat because if they have about $3 billion of free cash flow, even if I gave them a nice growth rate, I could see that the business is worth 60 to 90 billion dollars in market cap. They're way above that and they have a bunch of debt. So it's a very reliable revenue stream because everybody needs power. But this one's just not it's not going to make it for me. I'm not really interested in it. Constellation Energy. I looked at that in the past and I want to say some famous investors own Constellation Energy. CEG. Two of them. Torrey Funds, Poland Capital. All right. And which company does Warren Buffett own? I know he owns utilities. Warren Buffett and I should say Berkshire Hathaway, they like utilities. They really like them. And the new CEO is really knowledgeable in that area. So let's see here. Okay, I had a Constellation there, right? Constellation Energy, but no, they have Constellation Brands, which I think is a beverage company. So yeah, I guess my memory served me wrong on that occasion. They don't own any utility companies that I'm seeing there. Okay, so let's take a look at Constellation Energy. For the year to date, wow, nice, good, phenomenal. What's going on here? Constellation Energy produces, sells energy products and services in the United States. It operates through 5 segments: Mid Atlantic, Midwest, New York, and other power regions. They do electricity through natural gas, sustainable solutions. So they do hydro, they do nuclear, they do wind. Okay, it looks good. And their market cap, I believe, is less than NextEra, right? Yeah, 166 versus 112. And they have a P ratio going forward of 31.45, small dividend. So their stock's gone up really well. And look at this here. Like, their growth isn't like incredible. That's why I look at the stock price increases, the percentage increase, and I'm like, wow, they must be growing revenue like crazy. And it's like, nope. They're not growing revenue by like crazy. They're just growing it by 3.5%. Well, why is your stock going up so much? Are they making tons of money? I'm looking at the trailing 12 months here. Well, first, they don't make a whole lot of cash because they have to put so much back into their operations and production and stuff. They make some revenue, some profit, 11%. And that's good, but it's not great. I mean, you can buy tech stocks that are delivering profit margins of 30 to 40%. So this is okay, but it's not anything to brag about. But the stock's really roaring like, man, they're going to be so valuable. Well, maybe, but I'm just not seeing the dollars and cents on their financials. I'm just seeing kind of okay numbers. Now, when we look at the forecast, like NextEra, these guys are expected to grow. So growth looks good. And their P ratio will come down into the 20s over the next 3 years. So this one looks expensive to me. It looks expensive. It doesn't generate free cash flow. I don't think I have a valuation on CEG. I better move this off my screen. It's going to keep confusing me. So let's look for CEG. Yeah, I don't have it because just the numbers are kind of underwater for me. So that one there, I'm just going to scratch off. All right, let's take a look at First Solar. And if you joined, I'm kind of following a thread, seeing if I could find a couple of good diamonds in the rough here, especially around solar. So I'm going to look at First Solar. Let's see here. All right, so First Solar year to date. Wow, look at that. When did I see this sooner? The 1 year looks good, year to date looks good. And this thing's had an up and down kind of existence. Market cap 28.9. First Solar, a solar technology company, provides photovoltaic solar energy solutions in the United States, France, India, Chile. I have some of their equipment installed on my home. I have an app that I go on. I can see how my solar panels are producing power. The revenue is $5 billion. Forward P is only 12. Man, this is a good looking stock. Well, I should say the performance of the stock is really, really good. And they came out of that tariff-induced sell-off and have really done well. Okay, so looking at their growth, really good growth in 23, 24. Now, some subsidies were taken away, but that's not slowing them down. Look at that. Beautiful number, 31% growth. That looks great. How do their margins look? So free cash flow, they are free cash flow positive, gross margins of 40%. They're making products. They're getting equipment out the door and installed or sold to distributors and installers that are going to install the equipment. Their profit margins do look really good. So interesting. So it looks like the solar industry, First Solar is doing well, doing well. It's a surprise. I thought when they lost their the tax incentives, because there was these tax credits you would get when you buy solar for your home. I took advantage of those. I forgot how much they paid, but it was pretty good chunk. It was either like 25% of the cost or 33% of the cost is what it ended up being, but it was a pretty good chunk. All right. Growth looks good in the current year, looks good. Next year looks good. Year following looks decent. And then they're going to have a little bit of a growth plateau. So they're going to have to figure out how to grow. But the next 2 years look okay. And the profits are going to really expand in 2026, bringing down that PE ratio to single digits. Wow. So go First Solar. This is doing well. So First Solar is not going to have enough cash to value the company up to this level, but their forecast looks good. And the analysts think it's a little expensive. It's probably gotten a little too expensive. It's really rallied higher, but it's good to see that the market is buying up these solar stocks. I thought that solar was untouchable, but here I am coming back to this thread going, man, there was some money made in solar. So I would say this would be a good watch stock, but I don't know that it's all that exciting now. While I'm talking about First Solar, let's talk about Enphase. These guys have been going in the opposite direction. And for the 1 year, so these guys were really doing well and not so much. Small company, $4.22 billion. Forward P at 15.6. Analysts think there's a discount available on Enphase. All right. Historically here, their revenue has really contracted. 42% contraction in 2024. They were growing real fast. And these guys sell a lot of the products that are used to install solar arrays on roofs, or some people install them over land. But that's the equipment you buy and you're able to connect them. All these inverters that get put on the solar panels to convert that power from direct current to alternative current. And this company was growing really fast. Trailing 12 months. I'm seeing some growth here, folks. Did we find a diamond in the rough? Well, let's brush off the dirt. Maybe. Let's keep looking. Analysts think there's a discount here. We saw that First Solar is doing really well, but maybe the success is short-lived. They're growing this year. They're supposed to contract next year, and 36 analysts are putting in their research into that number. So I think the road is going to be a little rough for Enphase. As we look at the growth in revenue 2 years from now, it looks okay, but you can't have this up and down cycle. I think you're just going to lose the market's confidence in your company if you keep contracting every other year. Now, it's surprising that they're contracting. So I'm going to watch Enphase and see if maybe the market has it wrong on the growth. And if they start forecasting that they're going to grow for a couple of years, this stock may be a good pickup because it's a small cap. Some of its peer companies, like First Solar, are flourishing. They have a good balance sheet. Free cash flow is $217 million. That isn't too bad. The business is probably worth $4 billion. So let's do a valuation on this one here. So good to see you, Paul. Benton, hang tight. Mark, hang tight. Man, thanks for showing up, guys. Ricardo, Shadow Guy. Good to see you guys. Hang tight. I'm going to get to your comments in a little bit. Let's do a valuation on Enphase. See if that is going to be a diamond in the rough that is worth following. So this is a little dated. So let's update this here. So I have a high discount rate on Enphase because I thought it was really risky. We were going into a period when they were removing all these tax incentives. But now I think I can go down to like an 8.5. Interest rates are lower. And I think Enphase and First Solar are figuring out how to operate without that government assistance in the marketplace. So looking at Enphase, their current numbers, I'm going to go look for those numbers, and then we're going to come back. And their free cash flow is $217 billion. Now, the first year we were going to grow, or the forecast is that they're going to grow in 2026. No, they're growing this year by 12, and then they're going to contract. So I'm going to take away the growth on the first year, and we'll grow it at 10%. Yeah, that's fine. And 4%, that's fine. So you see the cash flows in the future discounted by this discount rate. They're worth $5.2 billion. Now let's take a look at the balance sheet and update the cash and the debt. Cash is $1.48 billion. Debt is the number that you're seeing there. Okay. So there's a discount of 23%. If we look at the value of their cash flows, taking a net present value calculation using 8.5 as a discount. So that isn't too bad of a number, especially if we're beginning to see, and I'm not done researching these guys. I'm going to come back and see if we can start to find out, why is their business going to contract so much while the energy consumption is going up and energy demand is going up. And I think a couple of weeks ago, if not a month ago, we were talking about how much energy is being consumed. And somebody in Ohio mentioned that the rates in Ohio, at least where that person resides, are up a lot. I totally get that. Well, that's a big motivator to get solar. It's like, man, if your solar's going up, get solar panels. It'll reduce especially your daytime consumption, which is when, at least where I live, they charge you more during the summer when everybody's running their air conditioner. And that's when the solar panels create the most power and they save you the most. So that is interesting. All right, let me take a look at the forecast here and see what earnings per share number they're going to have next year. $2.13, 12 PE. Then they're going to grow that number in the year after by 27% and then 10%. So we'll go with 17%. So this Enphase is getting there. I think it's getting there. So let's take a look at this. What is the revenue forecast? I'm going to say 3 year. All right. Let's see here. Yeah, even Gemini's seen that dip that we're in a nice growth year, then we're going to dip, and where it's pulling it's getting its data from Wall Street Zen, Simply Wall Street. So the expiration of the tax credits that happened. That's very much in our rearview mirror. I think they expired er, early in 25. So it's like maybe even at the end of 24. So that's kind of already done. Okay. I'm still thinking they're going to grow next year. That's what my gut says because I'm seeing First Solar and other businesses grow. So this is going to be a watch stock for me. It's not quite an obvious, like, hey, this thing's probably going to be worth a lot more going forward. All right. So let's go to Next Tracker and see what this one's all about here. Next Power, I guess it's the same company. Yeah. Tracking Solutions. And these guys, they do a technology that, make sure I'm looking at here's the man, look at this solar array, huh? This will power up your house. And if I recall these guys, yeah, they do equipment, and these solar panels will swivel to follow the sun. And you see how they're swiveling and adjusting so they can catch that sun. Good idea. That way you grab as much energy as possible. Let's see, $13.5 billion market cap, small market cap, forward P at 21.7, fairly priced according to analysts. Stock is rocking. Look at that, 149% increase. 1 year, 150. Man, why am I missing these stocks? Geez, that is a beautiful rise, huh? Going from $40 a share in 2025 up to 90. Double your money. Okay, growth, consistent, very good. Trailing 12 months, 20% growth. That looks terrific. And when we look at the free cash flow, and they've grown that cash flow, looks good. Gross margins are tight because they create a product, and their profit is okay. It's good. When we look at their forecast, analysts think they're fairly priced. The stock's really going up a lot, and they're going to continue to grow their revenues. So we are in the year that is going to end March 31st, growing at 17, going to 11, 13, 11, and then 11. Their earnings per share is going to grow nicely. PE ratio is going to come down. So this one here is it's bid up. It's been bought into. Looks real good. Now, at their current free cash flow rate, let me double check their cash flow and their balance sheet while I'm at it. Plenty of cash on the balance sheet. Lots of cash, no debt. They do 600 million. So these guys are, yeah, they're, I mean, you can value the company at this number, maybe even a discount. But man, it just feels like I'm buying this stock at the highest price I'm going to see for a while. It was at $40 a share 8 months ago. And it's more than doubled. And its profits are not that great, but there you go. This was a diamond in the rough a year ago. But for now, I'm just going to watch it. Looks good. All right, let's take a look at Sunrun. So Sunrun designs, develops, installs, sells, owns, maintains residential solar energy systems in the U.S. Okay. year to date. Geez, 109% increase. It got really hammered, but it's really on the rise. $4.5 billion market cap, revenue 2.3, forward P of 31. And they have a small discount according to analysts. They have been contracting. Interesting that the stock's flourishing that much while the revenue has been declining. Now, the revenue has been over the last trailing 12 months, it's growing at 14%. So that looks better, right, than the last 2 full years. And when we look at the forecast, this year they're growing at 18 after having 2 contracting years. They were growing like crazy back here, and now they are doing quite well. That's a pretty good forecast right there. Now, what I'm curious about is their business model. Do they lease out the panels and then have kind of a steady stream of revenue? And is that what Wall Street really likes? Maybe. So, and that might be the case because look at all this debt. They have a lot of debt on the balance sheet. So they may be buying, see debt to EBITDA 38. Whew, man, that's pretty bad. But what may be happening is these guys are owning the equipment, but and they're going to, in essence, have a reoccurring revenue for their company. Wall Street likes that. So pay as you go, pay when you use it. So yeah, they're owning equipment, and then homeowners will pay kind of, instead of paying a utility bill to your power company, well, you'd probably be paying 2 ways unless you completely produced all your power, had batteries, but you may be buying from the public utility and producing your own power with these guys. So I think Wall Street likes the model. It's easy for homeowners to get in, and they're setting up a reoccurring revenue for the company. So good for them. Let me look at their margins, see if they are making lots of money or barely getting by. So the growth is good. Free cash flow is terrible. Gross margins are not good. Man, how is this stock going up? They are losing a lot of money. Scratching my head on this one. I get that, it's going down this way because in a way they are, kind of taking a lot of risk owning the equipment and then producing the power for the homeowner. The 1 year it going up 96%. Maybe the stock was too low to begin with. But it's worked for a lot of investors. The forecast does look good. Good, consistent revenue growth. That's probably what the market's liking. Forward PE, it's going to get bad next year, but then it's going to get good. Real low PE ratio. They have debt. How can they pay off debt? We're going into low interest rate environment. Maybe that's another thing that the market likes, is we're going to have lower interest rates. And that's probably going to benefit these guys in a big way. They were pretty low priced, right? $6 a share. And if you saw, the promise of lower interest rates and so forth back in June, you could have made a killing. But I think the best is behind us on this one. And this one for me is a sell. And I would pass on this stock. It's just bid up a lot. All right. So I wanted to kind of follow a thread of interest, and, just to recap, renewable energy, solar. It is surprising that First Solar, the stockholders of First Solar, have made a lot of money. Enphase may be a good stock to watch because it's as its fundamentals improve, I think the market could really buy up that stock. And a couple of these stocks have been just really flourishing and performing really well for investors. All right, so I am done with the thread into solar. Let's take a look and where did I leave off? So Ricardo, you want to look at, and how you doing, Shadow Guy? Good to see you again. Ricardo, you want to look at XYL? Okay. So let's look at XYL. And Mark. So we can look at SFM, which is Sprouts Farmers Market. For a while, this one was like just a superstar stock within groceries. But last time I looked at it, and it's been maybe a month or two, things were not good. But let's take a look at it. So, Benton, what sector do you think will have investors' attention the most in 2026? Whew. It's a big question. I don't think technology is going to leave kind of like the stage. We're still going to focus on AI. And if AI continues to work, those stocks are going to be fine. They're going to not go up as much as they have over the last 3 years. But the flip side of that, if we see a reduction in investment in the data center, those stocks are going to get sold off fast. We've seen a couple of situations, episodes, examples of how the market will sell off data center stocks quickly. I mean, just over the last 2 months, we've seen that. And that could repeat itself in 2026. So most definitely technology is going to be center. And other hotspots, I would think that healthcare, it'll be interesting to watch, especially around the government's decisions around subsidies. Some finance pockets are going to do really well with low interest rates. So it's kind of a question, but I think every sector will have its opportunities. Like consumer discretionary with low interest rates and the consumer buying products, there's probably some good value there. I don't think consumer staples are going to be that great next year. Industrials, there's probably some industrials there. So we got to do a lot of homework because over the last 3 years, the market's just gone up so much. You look at these things over the last 3 years, they've gone up a lot. So trying to find value in a market that's this bid up, you may have to look at alternative sectors like healthcare and so forth. So we'll keep researching it, see what is going to do well. And while we're talking about that, you may have seen it, you may not have seen it, but one of the members suggested, hey, why don't we have a contest and have people pick the stock they think is going to do the best in 2026. So I sent out the announcement on Discord and on the YouTube, homepage, and just as much as I can. And I'm behind. Okay, I'm probably 2 to 3 hours behind seeing what other people want to put as their stock, but we already have some takers. We have companies believing Fubo could be the best stock next year. Zeta, Dave, SoFi. Put your best stab at it. Get on Discord, get on email. I sent out an email to all members. Go on the homepage and let me know what you think. I'd love to put your name on there. And what I'm going to do is I'm just going to set the price on January 1st and then just do a current stock lookup and the percentage change. The winner is on December at the end of 2026. Whoever has the best percentage change is going to be the champ. It's going to be the winner take all of all the glory of picking the best stock for 2026. So let's have some fun. Get to me however you'd like and let me know which stock you think is going to do the best next year. And then when investors like Benton asked me what sector is going to do great, I can maybe go, well, the list, a lot of investors love this particular stock or this particular sector. All right. Can Siri make a comeback on Apple? Well, my wife was using it today. Maybe. I don't think so, but maybe. I just don't see that it's getting any traction. Maybe they have to change the name. That's what Salesforce did with their AI. They changed the name altogether, kind of like, hey, instead of trying to reboot, let's make the market think that we have something new. So, Benton, you want to look at LOAR. So, LOAR. Okay, got it. Paul, how you doing? Best performing Mag 7 stock for 2026. Out of the Mag 7, Meta. That one's easy. Because it's so this is the 1 year, and Mag 7, like Nvidia, I guess Broadcom could be put in there. Apple's not growing. Microsoft's kind of stuck in the mud. I would say it's going to be between Meta and Microsoft. Wow, but it's going to be between Meta and Amazon. I think Amazon's really being counted out. I think Amazon could be the best performer out of the Mag 7. So I'm going to give you a grouping. I guess I'm going to put Amazon number 1, Meta number 2, Microsoft number 3. Google's done so well. I just don't know that it's going to lead the pack in 2026. I'm not selling my shares, but that's just what I'm thinking. Good to see you, Paul. My man, Peter. How are you, sir? PLMR. So PLMR. Is that Palomar, the insurance company? All right, on the list. 100% financials. Cool. All right, we got another. I haven't seen a pick from you, Benton, so let me know. Not on the chat for the live stream. I can barely keep up, but if you want to get on Discord or email or go to the home screen, get me a message and put your name on the board. Let me know what you think is going to do well next year. And then Benton BWTX. What is that? I don't know what it is, but we'll take a look. All right, let's get cracking here. Brucey wanted to see hack. What a stock symbol, huh? So hack. So this is Amplify Cybersecurity. It's an ETF. Oh, Ben 10, you're in. Yeah. Sorry. So Ben, you're already on the board. I apologize. You're good. Yeah, SoFi is a good pick. It did well this year. We'll see. Okay, so this is an ETF, cybersecurity ETF. Its holdings are, but cybersecurity, what's it doing with Broadcom? So let's read this thing here. So the Amplify Cybersecurity ETF is an exchange-traded fund that is based on Cybersecurity Select Index. Okay. So year to date, not doing all that great. So if this is like the performance, not very good. It's okay, but it's not great. Its biggest holding is Broadcom. That's not a cybersecurity stock. Cisco, you could say, is a cybersecurity stock. They do have a lot of cybersecurity products, but mainly they're a networking company. CrowdStrike definitely is. Palo Alto is. General Dynamics Corporation, that's aerospace and defense. Northrop Grumman, aerospace and defense. Fortinet, cybersecurity, 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 cybersecurity. Okay. I don't disagree with any of those. Fastly, I'm not sure. I agree. I agree. I agree. I mean, you're kind of diluting kind of like what I like doing in cybersecurity, and I've done well. I bought um Zscaler at the right time, had a good run with them, sold them, moved on. Now I'm in Fortinet. Um and I think you can pick the best in the pack that especially have the best forecast, and that I wouldn't buy an ETF, not in this category. It's like you're kind of taking um I think you're taking all the bad with the good, and I'd rather take all the good and that's it. I'd rather get all the best companies that I think are in the space. So, um, it did okay. Let's take a look at the performance year to date. 10%. Again, it's not negative. That's good. Okay, that's fine. And then 39%. Okay, that's not good enough. That is less than 10% compounded annual return. That's not good enough. So that's the problem with you're taking a lot of stocks that are bad and putting them in with the good ones. It's like, well, do the homework and buy the good stocks, especially around cybersecurity. It's not that complicated with cybersecurity. You can find the ones that are have the best forecast. There's good profitable companies, and stay away from the ones that have a lot of problems. So I'm going to create a video. I created a best and worst stocks in cybersecurity, and it was maybe about 5 months ago. So probably in about 2-3 weeks, I'm going to create a video updated on best and worst of cybersecurity stocks. So that is my review of Hack. It is not going to make it for me. So Celsius, Mark wanted to look at Celsius. Celsius is a beverage company. They do an energy drink. And so we got New Year's Eve coming up. You want to stay up all night, New Year's Eve. Pick your poison. You want to drink some Celsius, some Red Bull, some Monster, and you can stay up all night. Me, I will be comfortable in my comfortable home with my wife, just chilling out, have a nice meal, and I will not stay up all night. I'll probably call it a night shortly after the stroke of midnight and welcome the new year and then go to bed. But back to Celsius. For those that have been observing this stock from October to now, over the course of 2 months, this stock has really sold off. Now, the performance of the company in that time looked pretty darn good. If we look at the quarterly, they have been growing. Okay. So, what did the market not like? If we look at their profitability is good for a beverage company. We've got gross margins of 52, and you can see that they've been growing them a bit. And their profit is tight. Maybe this is what the market doesn't like, is the profitability is low. Cash flow is good. So they do cash flow well. Looking at the forecast, looking down the road a year, 2 years from now, when we look at Celsius, the future looks pretty darn good. We're in this year here. They're expanding. And next year, they're supposed to expand, 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 expand. That looks good, folks. P ratio is going to come down, come down, come down, come down. I don't think it's going to come down that low because they're really executing well. They're expanding their profitability. A lot of good stuff looks to be in the future here. Let me take a peek at a look at their balance sheet. They don't have a big debt problem. Okay, they've got net $88 million of debt. And it looks like Genetic Smite. Thanks for the comment there. So they just bought the rights to Rockstar. So that's going to help them, get more revenues. And these guys, like if you look at Red Bull, Monster, these beverage companies, they're not building factories to produce their product. They own their recipe, and then they have these agreements with bottlers. And they have bottlers in geographic areas, in essence, create the product and then deliver it to Costco, Target, Kroger's, wherever the end market ends up being. That's how they do business. So if they got the rights to Rockstar, it's just another revenue flow that they're going to have. And I am wearing a Red Bull hat for F1 racing, but I do not drink Red Bull. But it would amp me up too much. All right, cash flow $523 million, but I've got a full valuation on this puppy. And I think, I'm not, a big investor in beverage, but this one looks pretty darn good, man. 32% discount. So it's discounted based on their cash flows. It's priced right based on their earnings per share. So there's a lot there when it comes to Celsius. That big price correction, and it's not the first time these guys have seen some volatility, right? These guys were just setting the world on fire. And then they got too close to the sun, and the wax melted off their feathers, and whoo-hoo, they came down. Man, look at that. From 95, and this does look a little too euphoric, right? Even those that saw this crash didn't learn the lesson, and boom, look at that. And it's went from 95 down to 22. Ouch. Stock started to roll higher, and now it's back down. I think their fundamentals are good. The good news is that if I drew a line, it's upward. Okay, so it's not a bad stock. It's a good-looking stock. Small. So it's not in my wheelhouse, not in my zone of knowledge, my zone of confidence. But I could see somebody that's like more a consumer of these types of beverages, and they might be like, yeah, Celsius is better. It tastes better. People like it. The vibe is real positive for their drinks. Cool. There you have it. Go for it. All right. So let's keep rolling. We got Celsius on the board. I'm going to jump over to NVO, Genetic Smite. So Novo Nordisk had a good day. Boy, they needed it because this is a terrible chart. Look at this chart. Oh my gosh. You were just taking investors, growing their wealth. Everybody's happy. You got a really good drug. And then the market started to hate them. Just, no, we don't like Novo Nordisk. It just seems like they were really trying, but nothing was working. Now, it was a good day after a miserable year and a half. So in my book, man, I'll call me when they get to $75 a share. Then I might invest, because I did invest at a couple of times here, and it just was a wasted time. It was distracting, and the market just has it in for this stock. It's discounted. It has a good dividend. It has good drugs. It's growing. Look at this growth, quarterly growth. Now, the growth is contracting a bit, but they have an oral version of their weight loss drug now. That's going to be, I think, going to pick up to revenue. So, intellectually, NVO is discounted. If you just looked at the numbers, it's a buy. But it's how we buy, when we buy. You got to take everything into account. And we looked at NVO yesterday, and Daryl, who's really good with technical analysis, he looked at it and he's like, man, the technicals look horrible for this company. They do. Now, the good news is there's probably, well, I don't know if there's good news. There's probably a lot of investors that are sitting at these higher prices. What they're going to have a hard time doing is if they get up to 80, there's going to be a lot of sellers because they're like, oh, finally, I bought the stock at $80 a share and finally came back to my stock price. I'm going to get out before I get hurt again. And then they're going to deal with once they get to 100, same. So I think once they prove that they have an upward trend, I might be a taker of NVO. I think it's a good business. I think their forecast looks good. And this forecast is not going to include the oral medication they just came out with. That could really improve their revenue, but their revenue is supposed to expand. So NVO looks good, but welcome to stock investing. Sometimes we find all the right numbers and the market just doesn't care. It's not gonna buy into it while it buys its competitor. Eli Lilly's has just been fantastic, but it's priced too high. NVO is discounted big, and it's a big cap. But I'm going to wait for it to start to prove to me that it's on an upward rise, and then maybe I'll be an investor. That's what I'm going to do. I'm sharing my research with you, and hopefully you find it interesting. Thanks, Genetic Smite, for asking about NVO. That was a stock worth talking about today. GFS. What is GFS all about? GFS. Global Foundries. Last time I looked at these guys, it wasn't a pretty picture. These guys are, as the name would state, a semiconductor foundry. So foundries are where they make these semiconductors. Here's a nice picture of it. They're making the semiconductors, and Global Foundries will take orders from companies that want their semiconductors produced by these guys. They're a very small version of TSM, Taiwan Semiconductors, but nowhere near the capabilities of TSM. They have just gone nowhere over 5 years. It's just been dead money. This is a big distraction stock. Revenues of 6.79. Meanwhile, TSM's been growing like crazy. And forward P of 20. Well, that looks somewhat encouraging. Let's take a look. When we look at these guys contracting revenues while we have an epic growth in semiconductor sales, they should be growing, and they're barely inching out a growth number. Not very good. When we look at their free cash flow, they do have free cash flow. Their margins are not very good. Like TSM has way better margins than that. And they're just barely squeaking out. They're not even squeaking out a profit. Barely breaking even. So, no thanks. Global Foundries is just, there's other stocks that look terrific and not terrific, I would say investable in semiconductor because they're expensive. Let's look at the forecast. I'm curious to see, are they forecasting growth? They are. So that looks good. So the growth, they're supposed to start growing. I mean, this could really turn things around for them. So we're in this year. They're just scratching out a little bit of growth. So that looks a little better. Looking at their, always look for the debt level, okay, because that could be a problem. Here, they don't have a problem with debt. So this one here is worth watching. If they can really improve their business, I think you can catch this stock and take it for a ride higher, like make, nice 30% rate of appreciation if they start to really hit on that forecast. So that's Global Foundries. It looks good. It looks good from the forecast, but man, everything else, like its history and how it's performed in the past, has been brutal. If they start operating with this type of growth, especially hitting this double digit, this stock's going to start working. So this is a good watch stock. And when do they announce their earnings? February 10th. So I would, if you're interested in Global Foundries, study this earnings, study what they're saying about their guidance. If you're confident they're going to start growing, not a bad idea. It's got some decent bones. It's a good stock to watch. Ricardo wanted to look at XYL. XYL. So these guys do water infrastructure, applied water, measurement, control systems. Okay. So they're an industrial. Okay. Cool. So these guys capture and reuse rainwater. Good. Okay. So this is an example of what they're doing here. Okay. So that's what they're in. They're in water, reclaiming water, filtration systems, piping. Okay. All right. So it's a business. The demand will never go away. We're going to need water forever. These guys are up 19.48. Okay. Not totally bid up. $33.75 billion market cap. 8.89 billion in revenue. It's not too bad. It's like 4 times sales, which isn't too expensive. Forward P is 25.56. If they're growing, got no problem with that number. They better be growing. Price target 16%. Historically, they have been growing. And if we look at the trailing 12 months, the growth is slowing down. This is a concern here where we went from double-digit growth and now we're single-digit. Quarterly, so they hit kind of a couple of slow quarters. Q3 24, Q1 of 25. They are growing again. That's good. They got to keep growing. And let's look at how profitable they are. So they do generate good free cash flow. Gross margins of 38%, profit margins of 10%. Those are decent numbers. 10% free cash flow margin. Okay, so if I went 30 times their number, that would give me 27 billion. If I'm multiplying this and I'm rounding up to 900 times 30, I'm going to get 27 billion. And if I minus debt from that number, that'd be kind of like roughly where this stock is going to value. And they have about $1 billion of debt. So they're about $26 billion in value. They're at 33.75. So this one here, I think is a stock that is going to be a necessity, but the fundamentals are not um, great looking. They're good, but they're not great. Let me look at the annual just to see their cash flow. So cash flow, it has grown over time, but it hasn't been like a nice smooth growth. It's been up and down. So I think this is a nice safe stock. It's, water based, or it's dealing with water, and we're going to need water forever. It's never going to go away. I'm just not excited about, like, what would be an investment instead of this one that I would rather be in. I'd probably say I'd probably be in the oil business or in the mining business, because if the commodities work, like oil prices have been, if you compare it to history, really low this year. And if they start going up, and let me tell you, the US and Venezuela getting in this conflict, that can send oil high, because Venezuela is a big producer of oil. We disrupt that from the global market, especially China is going to have to find oil and buy it. And that's going to drive up the cost per barrel. So we'll see where that goes. And the reason I would want energy is I think that gives me good upside and gives me good dividends. But this is a good idea for a conservative stock, slow grower. Um, if that's what you're looking for. All right. So thanks for asking about that, Ricardo. All right. So now we're going to handle. Okay, we covered PLMR. PLMR. Palomar Holdings. This guy's your insurance, right? Yeah, insurance. So what's been happening to these guys? I reviewed them not too long ago. They started, looks like they've been working a little bit. That's good. So these guys went up and came down. Overall up 30%. Wow, for a while, this thing was really moving, huh? From 100 up to 175. It came back down. Now it's beginning to work again. And insurance is a good idea. It's a good idea most years. There's a reason why Warren Buffett likes insurance companies. Insurance companies know how to make money. That's why he likes them. So let's take a look. I have some good research on Palomar. I'll show it to you in a little bit. And I'm going to start with growth. Look at that growth. Nice. Very nice growth. Trailing 12 months, 54%. Looks good. Looks good. And looking at their forecast, this thing's a little slow on me. So I think they acquired a business. That's how they went from 553 to 2 billion. We're going to double check that, but um, that's really hard to believe that's all organic. Then we've got 26 growing at 21%, then 15. This is good growth. This is faster than Allstate. Progressive, I don't think has grown that fast, but Progressive's massive compared to this. This is kind of a small number compared to Progressive. And the PE ratio is really dropping. So the PE ratio looks pretty sensible. So let's go over their website and see if maybe we can, you know what? I keep doing that. I keep doing old school stuff, but I got Gemini, man. Why don't we have Gemini do all the hard work? It's going to burn a bunch of electricity doing so, but then we can just arrive at So did Palomar acquire anybody? Yes. Palomar has been very active in the past 2 years, completing multiple acquisitions. So they acquired Gray Consulting, Casualty, and Surety in October 25. Advanced Ag Protection in 25. First Indemnity of America in January 25. So these are all acquisitions. Acquisitions are okay, but it's not organic. Organic's the best growth. So they get, they're growing, I think, organically now, which is good. I'm going to look at their book value growth. That's important when we look at, and let me go straight to my research. I did some research on insurance. I wanted to buy the best insurance stock there is out there and see if I can make money like Warren Buffett. So here's the stack ranking. Palomar's here. Their PE ratio at that time that I did this research was 14.6. What is it now? 16.48. So it's gotten a little more expensive. But back then, and when did I do this research? I did it in November. Okay, so I did it October, November. And so Palomar has a PE that isn't the most expensive. The most expensive is Root, but it's a little more expensive than most. Even Progressive was less expensive, and that's a real good stock. And the other ratio we want to look at is return on equity. It had a very good return on equity, 22%. Price to book, it's expensive. You want this to be as low as possible. The green numbers are the ones that are the best in that category. Okay. So Allstate's the best PE ratio. We want the lowest. Progressive is the best return on equity company. And then there was a close kind of tie here. ACGL and I think this is Fairfield. They were the best price to book. But I ranked Allstate because it was near the top on a couple categories and had the best PE ratio. So that was my number one. I put Progressive way down here because the PE ratio is a little bit high, and then the price to book is really expensive. So these are the ratios you want to look at for insurance. You want to look at PE ratio, return on equity, price to book. And Palomar is beginning to rise. But let's look at it differently. I like this tool here. So this is going to be head-to-head. Palomar against its competition. And what is Progressive? Yeah, it's Progressive, Allstate, Chubb. That's good. So you see that Palomar like really took off up here. This is today's. Let's go 1 year. So Palomar is outperforming the pack. The market really likes these acquisitions, and it's outperformed the pack. Progressive has underperformed. Chubb has underperformed. Allstate has underperformed the market. Chubb, that's kind of surprising. When we look at the last 6 months, Palomar is underperforming. Progressive's underperforming. Allstate is doing okay. Chubb was the place to be for the last 6 months. For last month, Palomar is the place to be. So it's, if you understand those acquisitions and you feel like, hey, Palomar has really got something. I think they have better insurance products than everybody else, and you have that type of sentiment and kind of confidence. Hey, go for it. This is like Progressive's a pretty big cap, big market cap. Allstate's pretty good size cap. Chubb's pretty good size market cap. Palomar, I think, is still a smaller market cap compared to those giants. So insurance is good place, man. You can study insurance whether you're 35, 45, 55, 65, 75. Insurance has something to offer you at whatever age you're in. Good stuff. Peter, are you an investor, Peter, in Palomar? Did you make all kinds of money on Palomar? I hope you did. I hope you made lots of money on it. All right, so let's keep rolling here. And we're going to go to PTC. PTC software company. These guys, if I remember them right, they do product lifecycle management. Now, these guys have kind of been left behind the industry. Last time I looked at, and it's been a long time since I've seen them. Okay, so wow, look at that. Wow. That is a pretty nice looking chart there. Last 5 years, okay. Last year, not good. Okay. $21 billion market cap, so it's kind of small. Revenue 2.74. And then PE ratio 28.9. For the current year, 22.45. Looking at their revenue growth, that's good revenue growth for, and this is September 30th. So they just closed this year. This looks interesting. 42.65. What is going on? What's causing that growth? Did they acquire a business? Yeah, so they acquired this business, ServiceMax. Well, this was in 23. They acquired this one. I don't know that that's all that big. They acquired this business. Okay, so this doesn't look all that big. So I think their revenue looks organic. They're profitable, good profit, good gross profit. 83% gross profit, profit margin of 26. This looks good. Looks real good. So the forecast, are they going to keep growing? So they're having a very good year. They're going to slow down next year. And then they're going to grow at 8, 8, and 10. So this is kind of like in the range where Salesforce is growing. Adobe's growing 10, 11%. ServiceNow is growing 20%. So this number here is probably going to cause some selling in the stock because it's like, whoa, what happened? How come you're not growing as well as you did in 2025? I'm not sure why they would be contracting so quickly. Their PE ratio looks okay. So I like their growth for the 1 year. I think the market's looking forward a year and it sees that slow year and it's like, oh, okay, we don't want anything to do with that. But before that, it was really liking that growth, and especially the forecasted growth. So I think this is a good watch stock, and then wait for it to start forecasting that growth in 2027. And then this one might be good to get in early and then you'd be off to the races. Has good fundamentals. It drives really good cash flow, but it just has to have sustainable growth. The reason like Palantir is doing so great is that it's growing year after year after year. Well, when you sustain that kind of growth, the market loves it. Will buy up your stock. But if you grow and then stop your growth, that's not good. Market doesn't like that. All right, so let me check the chat real quick. So if you're not a member and you want me to look at a video, I'm glad to do that. Like somebody wanted to look at ASTS, just buy a $5 super chat and I can do the research on that. And then I just don't want you to think I'm ignoring you. So that's why I'm pointing this out. And then looks like PayPal. If you want me to research that stock, become a member or buy a $5 super chat, then I can research it. All right. Thanks for joining this stream. I appreciate it. Michael Anthony, good to see you. Lighten up the chat. Good to see you. Thanks for the comments. So, yeah, I mean, Chubb is Warren Buffett's an investor in Chubb. So, all right. So, we're going to move from PTC over to LOAR. And I typed that wrong. Okay, so this is Lauer Holdings. Designs, manufactures, markets aerospace and defense components for aircraft and aerospace and defense systems in the U.S. So these guys are going to be a subcontractor, probably to some bigger aerospace company. So they're creating some of the subcomponents and then sending them to Boeing or somebody else that's bigger. So aerospace has really gotten a lot of attention because there's more spending in that area. Year to date, this one's not doing all that hot. 1 year, not good. 5 year looks like it did well. Actually, this is like a new IPO. It IPO'd April 25th, 2024. It came out of its IPO, rose nicely, but the last year hasn't been all that great. $6.43 billion market cap, revenue of $475, very high PE. Analysts think it's discounted. We don't have a lot of data, a lot of years, but they are growing full year and they continue to grow. So the growth looks pretty darn good. 25% growth is very good. Gross margins, 52%. Those are good gross margins, good profit margins. Okay. Okay, so they are expensive because they're doing about $100 million in free cash flow. And I can get to 2 to 3 billion, but I can't get to 6.43 billion for this company. Aerospace tends to be lower profit than like technology or pharmaceutical. So it's always hard for me to value these companies at a really rich valuation. They are going to continue to grow. That looks good. Profit wise, they are going to expand profits, but their PE ratio, look at this PE ratio, it's going to stay really high. And I could buy Meta, I could buy a lot of really cool stocks for this PE ratio. They make a lot of money. I think I could, this is kind of PE ratio for Reddit. I'd rather buy Reddit. So I don't like aerospace. The numbers don't look all that great to me in aerospace. I'm always apprehensive in buying. But aerospace has been doing well for a year and a half. So these guys might be, I think they are priced too high. P ratio tells me that it's very high P ratio, not a lot of cash flow. It's a newer company, so we don't have a lot of history. And now the market's beginning to think, well, maybe we've got to give this thing some time to prove that it is more valuable to us. So it would be a pass for me. All right, let's talk a little grocery store. Sprouts Farmers Market. Mark, you wanted to talk a little Sprouts Farmers Market. Now, these guys for a while were on a tear. They were growing faster than the traditional grocery stores. They were adding new stores and so forth. And then they started to look like a grocery store or a grocery business. And I think their growth began to slow down. Now their growth looks fine. Quarterly. Yeah, the growth looks fine. Statistics. Okay, I was hoping I'd be able to see same store sales somewhere. So when we look at any kind of retail business and the grocery business, these are big retailers. We want to look at same store sales. So for Sprouts, Q3 5.9, guidance for Q4 0. This is what's ailing the stock. Is if you're not growing organically, the market doesn't like it. I don't like it. It doesn't show that, hey, your business is so good, more customers are coming to the same store and they're willing to pay higher prices because you provide the right assortment of goods and good quality produce and all that good stuff. So this is the problem with the stock. And if they're going to, this is a competitive market, right? You're competing against Kroger, big, Target, big, Walmart, huge, and then Amazon with Whole Foods and Amazon Fresh. It's like, wow. And that's not even including like Trader Joe's. These guys are modeled after Trader Joe's. Trader Joe's is privately held, as well as other chains like Albertsons and Stater Brothers and so forth. So now I'm pretty sure I have a valuation on Sprouts. I'm not sure it's going to start working anytime soon, but it is discounted 42%. So if they can figure out how to grow, the stock price is discounted. That's the if is when is the market going to start picking the stock up? If you see here, man, it's really sold off. So it's kind of hit kind of a bad zone here. It's just really sold off. If it starts to rally, and when are they going to announce? So they are announced October 29th. So they're going to announce end of January. Study their earnings announcement. If you want to take a chance, you can buy ahead of that earnings announcement, but you're taking the risk that if they come out and say, hey, we're actually going to contract, same store sales are actually going to be contracting, that'd be terrible. But I don't think so. I think food prices in general have been going up. Sprouts is a good store. Like whenever I go in there, I think they do a nice job. They probably charge more for things, but they have a nice, the way they display things and the foods they sell. They have a smaller footprint grocery store than the big giant grocery stores. So that smaller footprint helps them kind of sell the products that they want to sell. It's not like they're selling very low margin, product. They sell the stuff they want to sell. So that Sprouts, interesting that the stock flourished for a while and then just came back down. This is kind of like Novo Nordisk. Went up, came back down. Oof. It's kind of a lesson that on some of these stocks, because the valuation for this guy got really expensive. If we stay in a stock too long and then we go down this waterfall, we got to be disciplined. Knowing when to sell a stock, it's a skill. And we don't develop a skill like without practicing. Like if we see really good stocks, okay, maybe sell some shares, take some profits. I know that everybody would love to have like, oh yeah, I bought Apple 15 years ago and look at me now. Okay, cool. But then you have a lot of stocks like this one or Novo Nordisk, or, we can go down the list. This would have been a super winner for somebody. And I'm sure they had the discipline that maybe when they had a 4-bagger on their hands, boom, cash it in. 5-bagger, cash it in. 6-bagger, cash it in before this happens. And next thing you know, you're like, oh no, I'm down 50% from the peak. So there's the lesson of making sure that, selling is a skill. Ring the cash register on a stock that is likely hit its all-time high. It probably doesn't have a lot of good to go and is probably going to disappoint. So BWXT. So what do these guys do? So these guys manufacture and sell nuclear components, government operations, commercial operations. Okay, so they manufacture products for the Navy. Okay. Nuclear powered subs. Okay. Wow. Look at that. So it's really worked. The aerospace and defense industry really caught a nice rally. This is $16.24 billion market cap. P ratio is a little high. Growth rate, 8.3 for the last full year, trailing 12 months, 14. Their cash flow has grown over time. Looks good. Gross margins are low because if you're doing business with the government, they tend to be lower, but it's kind of assured that you're going to be profitable. It's usually cost plus. So you're not going to lose money, but you're not going to make a boatload of money either. So these are very respectable numbers. So this business is worth about 15 billion minus debt. I multiplied that free cash flow number times 30. And they have about a $1.5 billion of debt. So let's say they're worth 14 billion or so, and they're right at 16 billion. So this one here, I mean, it's done really well, but I don't know that it's going to keep doing well. And I don't know that the whole demand cycle around aerospace and defense, I mean, is it going to keep going? It could. I don't know. It's not the area of specialization that I have. I'm not a big like aerospace and defense investor. I know what they're about. I understand their businesses enough, but I've never been all that attracted to them. Been attracted mostly to tech, healthcare, pharma, financials, and some industrials. But this stock seems to have, really gone up to the levels where it's going to either stay or either come down. If there's any bad news, I think there'll be a sell-off. All right. So we covered a lot of ground. Geez, altogether, probably like 12 stocks, maybe 14. All right, guys. So let's call it a day, call it a night. Thanks for tuning in, everybody. Good to see a wide array of people. Remember, if you want to message me and be a part of the trying to predict the best stock for 2026, I think Ben 10 was on the stream. He's going with SoFi. Mike, the dividend investor guy, he's going with Fubo. We got somebody that's going with Zeta. Dave, I'm going with Oxy. Thinking oil might really do some fantastic things in 2026. I'm either going to come in near the top or near the bottom with Oxy. We'll see. We'll have fun with this. And send me a Discord message or get on, the post that I put on the YouTube channel. Send me an email. Let me know which stock you think is going to do the best next year. Be fun to track it. And then I'll track the who's in the lead every month. I'll kind of put it up there because I'm going to set it up so it's going to automatically track the current stock price and where it started January 1st. So it'll be fun to track it and kind of see who picked the stock that looked really good. And I bet you some stocks will be looking good at the beginning of the year and maybe fade middle of the year. And then another stock will take over. And then we'll get toward the end. It'll be a little bit like a season for a sports team. Hey, if you're not a member yet, consider being a member. I think it's a cool program. Love to invite you to member calls if you're an advanced investor or higher. I do a lot of content that's really released to advanced members or higher first. And then after that, it goes public like a month or later to the general public. And on live streams like you observed today, if you're a member and you want me to look at a stock, that I'd be happy to do that. And hopefully that is valuable to members of the channel. So consider it. It'd be great to have you. And I would appreciate you taking a look. It's on the home page of my channel. You can take a look at it there. So with that, guys, I'm going to let you go. And tomorrow morning, I'm going to be streaming with Daryl at 9 a.m. Eastern. And we'll stream for a couple hours. Hopefully, if you're around, tune in. We'll take a look at some stocks. And, Daryl does an awesome job on technicals. And I will handle fundamentals. All right, guys. Have a good night. Thanks for tuning in. We'll see you on the next stream.